QuickBooks Online 2025. Void check, prior period adjustment. Get ready and some coffee because we're learning to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody looking for a result that has intuit.com in the URL because Intuit is the owner of QuickBooks. We might have to then verify that we're not a robot, and I'm not a robot, at least not yet, although I have ordered those surgical implants to be put into my mind so that I can play video games faster. I'm just kidding. I haven't done that yet. I don't plan on doing that, but I bet somebody will do that at some point here. But in any case, we're in the sample company file, Craig's Design and Landscaping Services. Let's open up our major financial statement reports as we do every time. The report's on the left-hand side. We're in the standard tab, right-clicking on the balance sheet so that we can open in a new tab, right-clicking on the profit and loss, also opening in a new tab. Let's go to that middle tab where the balance sheet is located, closing the hand boogie. And we're going to change that range to a 2-year time frame, 01/01/24 tab, 12/31/25 tab, selecting the drop down to see it years, running to refreshing, 2024 and 2025 now side by side. Let's go to the tab to the right, close the hand boogie again, and boogie down on the date, 01/01/24 tab, 12/31/25 tab, selecting the drop down so we can see the years, run it to refresh it. Nothing is in 2025 except for that one transaction for some reason, including transactions we entered in the prior presentations because I've refreshed the data and I'm now in incognito window. If you want to follow along and refresh your data, you got to log back out, log back in, possibly use the incognito window. If you don't do that, you'll have the prior presentation data in the system and that might not bother you too much. So that will be okay, just so you know. Let's go to the first tab, selecting the plus button. We've been looking at the vendor side of things, which in essence is ultimately money going out for the purchases of goods and services that we're going to use to help us generate revenue, revenue generation being the goal of the business. We want to think about a transaction now to void a check in particular. And as we think about that, we want to expand in our mind the general concept of why that could be a problem. And one reason it is a problem is because in the accounting system, we don't typically like to delete things or to go back in the system and alter data input forms like any of these forms because we lose the audit trail by doing that. So if you just go back in and you change something, then you've kind of messed up what was done before. How would we prefer to see it fixed? You do another transaction to reverse what was done in the past because that gives us the audit trail. So that's one problem. Another problem is that if you go back and delete something, then oftentimes we're thinking about fixing one part of the accounting system, such as checks that never cleared and are showing up in the bank statements, or possibly they were entered twice or something like that. And we're trying to fix that, but we don't think about the other side of the transaction because every transaction has two accounts impacted, the other side of a check typically being an expense, which is on the timing statement of the income statement and has already been recorded, particularly if it's in a prior period. In other words, if I wrote the check or entered a transaction last year and it impacted the income statement, then I've already used that income statement for the creation of the financial statements and possibly for the tax return. If it was an expense, I've already expensed it, right? So if I delete it, then I'm going to mess up the prior year's income statement. And that's where the problem comes in. So we want to be very careful deleting things, particularly in a prior month or prior year. That could get you in a lot of trouble in an accounting department. The CEO or the accountant is going to go crazy. Like, you deleted some. They'll probably lock the system so you can't do it when you're in an accounting department, right? But bookkeepers have to be more careful because they have the ability to go in and basically delete things if you don't set up an internal control to close out the period and not allow you to delete things in a prior period. So checks are the classic example of this because you might, even if you have bank feeds, have pulled in for some reason two copies of a particular transaction. in which case only one of them is going to clear, and then you'll have the other one that never clears when you do a reconciliation process, and that's when you'll see it as a problem that you need to fix. You also have similar kind of situations like with a bill form, for example, where you might have look at your accounts payable statement and notice that you have these bills that are no longer due for whatever reason. And you're going to say, well, now I should delete all these, because when I look at my accounts payable, I should say, then I have all this information. I want to delete them, but you have to have the same carefulness in doing so, because if you just delete them, you're going to delete the expense forms that came up. Similarly, the accounts receivable will have a subledger to it, as we'll talk about in future presentations, and you'll have a similar case possibly where you're going to say, hey, look, I'm looking at my accounts receivable subledger, and I have all these amounts that they say that I owe to, that people owe me, but I'm never going to get paid that amount because they've been outstanding forever. I need to clean the subledger up. How am I going to do that? And the tendency is, well, I could just delete a bunch of transactions. But you don't want to do that just willy-nilly, because that's going to mess up, again, prior period types of transactions. So anytime that comes up, inventory is another issue where that comes up. Anytime where you're saying, I'm trying to fix a ledger, or I'm trying to fix the outstanding checks, and you're thinking, I need to delete all this kind of stuff, you have to say, okay, how do I do that? How can I do that so I don't mess up the prior period? Now, I'm going to show you this just in terms of journal entries first, so you can get a visual idea of what I'm talking about here. So if I go over here, let's just imagine in Excel that we had a prior period check, and it's going to decrease the checking account, let's say by $150, and the other side went into an expense account. And so there it is. So cash went down by $150, and then some kind of expense like telephone expense or whatever was hit down here. So now the net income went down because the expense went up. Net income has already been impacted. That expense, if we did our tax return, had already been deducted on the taxes, for example, or recorded on our financial statements for financial statements. So when I go into the next year, notice what happens to the income statement. It rolls in. This whole income statement rolls into the equity section. And then I start over with a fresh statement here. Let me see what I did here. This should be this one. So now we're in balance here, and we have nothing on the income statement. So what will happen then if I just delete the check? What's going to happen is I'm going to say, okay, well, let me void the check. If I just void the check, it's going to reverse that transaction, which is in essence like deleting the transaction, right? So let's keep it in the same format here. I'll just say and go, this will be negative of this and negative of that. So if I void it, the expense will go back down here, and this will be the cash. Now, that looks like kind of correct, but the fact is I already recorded this information on the tax return. So if I void it, what am I going to do? Am I going to adjust my prior period financial statements to reflect the fact that I didn't really have that expense? I don't want to do that, right? I've already issued those. I've already done the taxes. And now my retained earnings over here isn't going to be right because it's not going to tie out to the prior period's basically retained earnings, because I had actually finalized. I already finalized it before and reported that, right? So what I'm going to do is I'm going to undo that. And so what I'd like to do is record this in the current period. So in other words, I'd like to record this over here as a negative expense and the cash this way. So now what's happening is I'm adding it back in the current period, right? So now I didn't mess up my net income last year. My retained earnings still flows forward. This minus this matches my retained earnings, and I reversed it in the current period. Now there's a problem in terms of how exactly am I going to do that, like in QuickBooks, because if I void the check, it's going to void it in the period that I made the check, meaning it's going to void it on this time frame. So what I have to end up doing is something like this. I've got to say, okay, I want to see the audit trail and void the check. So how can I do that? Well, let's delete this for now, and I could say, okay, I'm gonna record the transaction with a journal entry again, basically, which is going to be an expense. And so then I'm going to say, I'm just going to mirror the same transaction. I'll record it with a journal entry. So it's in there 2 times as of the same date. And then, so I'm going to say this is going to be cash went down. And then it's in there twice. And then I'm going to void it so that QuickBooks sees it as a voided check. So I can track it as void, which is the way I would like to see it for an audit trail purposes. And that's going to be the reverse of this. I'm just going to keep the debits and credits in the same order so I'm not going to put the debit on top. In other words, I'm just going to reverse it. And so now I'm going to void it. So now I'm going to say that happens in last year, right? So I'm going to say the expense now is going to be voided, taking us back to where it should be. Yeah. And then cash. So now these 3 transactions get us to the same point, right? And then I'm gonna make the journal entry for the voided check in the current period, which is basically like a deposit form, which will be recorded on this side. So that's going to be let's do the same thing, the expense and the cash, and the expense this time is going to be this and this. And then in the current period, we're going to say cash is, actually that's the wrong way, right? It should be the cash is going up. So I'm going to say this is going to be that and that. So now we have then the cash is at the 150 and the expense negative expense. Now that's pretty tedious to do, but let me just give an idea of why this is the case. We have the original check. We want to mark it off as void to give us the audit trail, but when I do that, it's going to take it back to the period last year, let's say, when I wrote it. So when I void it, these two are going to match out against each other, right? But I don't want to reverse it last year. I want to reverse it this year. So I'm going to put it back on the books and the current period. I'll make this one green so that I could still see it and it doesn't mess up my net income, so that I can then reverse it in the current year, which is what I really want to do. So by doing this, I get the nice audit trail, and I get the fact that it's actually voided in the system. And I get the fact that that the current period's affected, and I don't mess up the net income in the prior period. One other problem that we're going to have is that these two amounts, all these amounts, are going to be showing up on the bank reconciliation. And that means I should be able to match them out, right? This one will match out against that one, making it so it doesn't mess us up on the bank reconciliation. And this will match up against that one, so it doesn't mess us up on the bank reconciliation. All right, let's get an idea. Let's see that in QuickBooks. So I can say over here and say, let's imagine we enter like an expense form. So I'm going to enter an expense form, and I'll do it for, let's just say Verizon again, Verizon tab. We're going to add that. It's going to be a check type form. And let's say that we do it as of, let's say it's in 2025, and then we'll say, the method is, I'll just keep it blank on the method. I don't need one. And then I'm going to scroll down and say it's going to go into the telephone expense, boom. And let's just do our classic 150. So this is an expense form, which is kind of a type of check form, decreasing the checking account. The other side go into telephone expense. Let's record it. We'll save it and close it and say, okay, what does that do? If I go to the balance sheet and run it, then of course in the checking account, if I drill down on the data in the checking, we should have a transaction. Let me refresh it here. There it is. So there it is, decreasing the checking account like we would expect. Let's go back up and back. Let's go into the profit and loss, run this report, and we can see it down here in 2025. There's the 150 telephone. What did that do to net income? It brought the net income down. So the net income for 2025 is now a negative 184. That's a loss. We can see how that's connected to the balance sheet because that rolls in to the balance sheet over here. And so there it is, the 184. So that helps us to basically be in balance. And so it's already been recorded. So if we filed the taxes, let's imagine for 2025, and it was done, then we would have taken this deduction in essence of the 150, and it would have rolled into our retained earnings. So if it now, let's imagine we go into 2026 and I void the transaction, it's going to mess up what I already recorded on the balance sheet. So let's imagine that. So I'm going to go back on over here and say, okay, now let's imagine that we're going to void that transaction. Oftentimes you could do this multiple ways. I could go into here and I could say, let's go into it from the checking account. And let's go into the transaction. What did I go into 2024? Let's go into 2025 checking account. And we could go into that transaction. And then I could void it here. So we have the void right there. But oftentimes we do this like in the check register. So if I close this back out and I go back and imagine that I was reconciling. So I'm going to go to the transactions. And when I did my reconciliations for the bank reconciliations, then I would say, oh, wait a sec, this transaction's been outstanding all year for 2025, and I'm now in 2026. We're imagining I need to get rid of it, right? It shouldn't be there because maybe it was entered 2 times, and so it's never going to clear. Okay, so one way I can do that is I can go into the chart of accounts. This is one way to get to the register. I'm going to close up the hamburger. Checking account, you can see on the right-hand side, you have a view register. This looks kind of like your checkbook if you had the old checkbook. And so it's just another format to see these items. There's the bill that we entered. Again, I can go into it here, and typically I still have to edit it. So notice you have the delete button. We don't want to delete it. That's going to be the first thing. When you go to edit to avoid it, you're kind of doing the same thing as deleting it. But at least it gives us the audit trail, so it's going to enter a transaction. So voiding it would be better than deleting it, although we still have a problem. So I'm going to void it instead of deleting it. So I'm going to say, all right, void it. And it says the transaction will stay in your books, but the amount will go to 0. Okay, void that. So now when I look at it, I can say, okay, there it is. That gives me a little bit of indication of what's happening. So if I go into this transaction, I see it as basically voided. So that's cool, and you can see it's voided up top. The problem with that is that when I go to my balance sheet, I'm going to run the report, and in 2025, that amount has been removed. If I go to my income statement, it's been removed. I'm imagining I'm currently in 2026, but when I go into my 2025 net income, it will no longer match what I reported as net income in 2025, such as, for example, on my tax return, for example. So that means it's not rolling over properly. So the next step is I have to go over here and say, and this is something I should have done before I voided it so I can make sure I see the dollar amount. So I would say as of the same date, I'm going to enter another transaction, and I'm going to say, let's say a new transaction here. And we're going to go, and sometimes I'll try to record these like as a journal entry. So here it is. Here's the little drop down for the transactions, because that'll tell me that it's kind of an adjustment. I'm going to make it as of the same date, which was 3/1/2025. And I'm just going to put it back on the books. So it's going to be telephone, what did I say? Verizon, and boom, memo, void, check, and then I check for 1/3, and then I'm going to put it back on the books for, what did I say it was? 150, I think it was. Let's just do the 150, and then it's going to go into the telephone account. Telephone. So now we just put it back on the books with a journal entry. So let's see what that does. If I save that and I go into my balance sheet and I run it again, and then now I go into my checking account, boom, checking account. I see here that I have the expense form, which has been voided, but then I have the 150 back on the books, which puts me at the same spot I was before, but it lets me see that this was actually voided, and this was a journal entry form telling me that I had to do something to void the check, and then the memo is telling me it's voided the check. If I go back, I go to my report over here, run the report, then I can see that the 150 is back on the books, and our net income should tie out for the prior period. Now I'm going to do another journal entry in the current period to do the adjustment in the current period so that I can actually write this amount off in the current period instead of messing up the prior period. So I'm going to go back on over and say, okay, now let's do another journal entry. And I'm going to imagine this happens on, let's say 01/01/26, because I'm going to imagine the current year is 2026 so we can see it. So I'm going to say the payee is going to be, let's just say Verizon again, and we're going to say to reverse void expense on 1305, and this time it's going to be a deposit side of things for 150, and then the other side is going to go to, well, I'm in, and then it's going to be on the deposit side of things, and the other side's going to go once again to the telephone. Okay, so let's enter that. So now what happens? All right, so now if I go back on over here to the balance sheet, let's change the date range again to 2026 now, and I'm going to run it for 3 years. So 2024, 2025, 2026. And so now I should have the same information in 2025, but in 2026 now, we have the reversal. Let me refresh it again. So there's the reversal in 2026. So if I bring this back to 2025 and 2026, you can see here's the original one, and we voided it. Then we put it back on the books to not mess up the prior period, and then we reversed it in the current year in 2026, right? So it's somewhat of a tedious transaction. And then if I go to the tab to the right and we do the same thing, I'm going to bring this out to 2026 and then run it. So now I can see down here that in 2025, we voided it and then put it back on the books. And then in 2026, it's been reversed, showing a negative amount, so that we're reversing the timing account in the current period rather than the prior period. And then we can see in here, let me refresh it again. So there's our journal entry here in the current period. Now, if I bring this back to 2025 and 26, then you can see what happened. We had it in there, then we voided it, we put it back on the books to not mess up the income statement for 2025, and then we reversed it in 2026 so that we can not have to go back and correct all of the reports that we did last year for income taxes and external reporting, but rather reversed it in the current period so that we don't have to do that, because that would be a pain to do. Let's go back. And so that's going to be the idea. Now, if I go back on over here, the next thing that we're going to have that will be an issue with this, if I go into the transactions, is the bank reconciliation. So if I go into reconcile, see if I can check this out real quick and say we're going to reconcile. Let's go. And then I'm just going to go into the checking account for, let's just say 12, let's say 01/31/26. Statement ending date, and oh wait, I want to put that here, 12. Oh, they're gonna make me use the calendar thingy. All right, calendar thingy. I'll say 2026 January, end of January 2026, and boom, and then let's check it out. And so in here, we're going to see then these transactions. So I have to check off all of these transactions, right? So we're going to see where are these 150 transactions. All right, so here they are, right? So we got the Verizons. So here's the voided one. So I can check it off. It's not going to mess me up because it's voided. And then I can check both of these off, which will cancel each other out. So they're not going to mess up our bank reconciliation. So we'll still have to check them off, but they're not going to mess us up. All right. So that's going to be the idea. And so we have to be that same concept. We have to be careful of anytime we mess up a prior period transaction. And now let's just touch on a few other places where that's possible that it could happen. If you go into your reports, anytime we have a subledger, such as let's go into like the expenses, and then go into the bills possibly, and look at the unpaid bills. Now let's imagine that you had unpaid bills here that add up to 1602. If I look at the balance sheet, we could see the balance sheet for accounts payable adds to 1602. So this is in essence the subledger. But what if we had bills in here that we don't think we have to pay anymore? We don't owe them, and they're just sitting in here. For some reason, there was a bill that was entered. We have to get rid of it. We have a similar kind of problem. I'd like to clean that up, but I'm skeptical. I'm scared to just delete the bill because that'll impact the expense that I recorded. So we want to make sure that if we remove the bill somehow, we do it in such a way that it doesn't mess up net income in the prior period, but reverses net income in the current period. Similarly, if you had the sales side and we had invoices, all sales invoices, let's say. So now we have receivables that people owe us, and we're looking for the invoices. This is in essence the subledger for the invoices. I don't have it tied out right. It doesn't give us the total right here, but the idea would be then if I have collection and I'm not going to collect on the invoices, then I have to write them off in some kind of way that again affects the current period and not the prior period. Similarly with inventory, if you had an inventory subledger and there was inventory, on the books or something was different on the inventory, then again, you don't want to delete transactions or something like that. You want to record things in basically the current period. So those are where those similar kind of concepts will apply out. All right.